Alright, so quite a long time since I put up a video, so I thought I'd put up a video. Alright, so the top is December gold and the bottom is December gold. Top is a 15 brick Renko and the bottom is a 5 brick Renko. You know what? I'm going to increase the brick size. Probably 25 brick Renko. Whatever. So what I want to mention here is this is just you put the volume in it. So a lot of times, you might have these fancy charts that have volume in them, like market delta, order flow. A lot of order flow, they have the volume in them. But you can use other types of charts that are a little more simpler and less confusing to read, and with less information, which is actually a good thing. So you just have any other chart and you put the volume in it. Alright, that's all you gotta do. So this is gold, and what I'm going to do first is just have a general conversation about buying pullbacks, how that's done. So the first thing is, and excuse all the writing I'm going to do now, but first thing is you need trend, right? You need trend. In order to buy pullbacks, you need trend. But not only do you need trend, it must have momentum. Alright? Without both, it's not going to work. There needs to be trend and there needs to be momentum. Alright? Without both, the market, it's just not moving. You could have false trend readings on the indicators and they won't work. You need both. You need trend and momentum, and you must be aware of the higher time frame. This is a lesson. This is a lesson that I learned the hard way. You must have awareness of the higher time frame levels. Alright? And the higher time frame trend and momentum. Alright? So on the small time frame you need to know trend and momentum, and on the higher time frame you need to know trend and momentum, as well as levels, the support and resistance levels or breakout levels that are being retested. They must be known, otherwise you're going to shoot yourself in the foot. So this together, this right here, creates context. Alright? Trend plus momentum plus levels on the lower and the higher time frame creates your context. Alright? Now there's much more to context than this. Like there's other things, the sentiment and all that, but you don't need all that. I'm just talking from the perspective of the basics. But this will do the trick. Right now for trend, you can use any indicator that you currently use for trend, but combine it with a momentum indicator when momentum is favorable. And higher time frame levels, you just put the higher time frame on top and mark those levels, because the price will react on the lower time frame from those levels many times. Okay, so that's the first thing. So the second part of buying pullbacks, remember this is a discussion about buying pullbacks, and then I'll go into this chart. Second thing about buying pullbacks that you really need to know is within this context you have this type of diagram. Okay, this is the basic diagram. Now this correction here, it can be A, B, C, which is the ideal, or it can be 1, 2, 3, but really more than this is, I don't take it. Wouldn't take it. I want this or this. So pullback structure is very, very critical. Okay, the structure is very critical. This is the best one, ABC, and then bang. You know, this is pretty good. This I've seen sometimes, but I mean, this is also, I'll talk about this. Now, the actual signals on the pullback. Alright, what are the actual signals here? Here. You know, here. Well, this is a game of supply and demand, folks. So, basically, you think from the perspective of supply and demand, what is happening. Now, what you'll have is something like this. Okay. So, the basic structure is rally and then a pullback. Rally and then a pullback. Rally, then a pullback. Now when you observe, you're basically looking at the rally within the right context, meaning bullish or bearish context. You want to observe the rally and the pullback. So obviously that's what you're looking at, the rally and the pullback. The basic structure is rally, pullback, continuation. Okay, and now from the perspective of supply and demand, you analyze both. So what are you looking for in the rally? You're looking for a rally with multiple bars. Alright, I want at least 3, but preferably 4 or more bars. I don't like 3, but 4 plus bars. But at the same time, it can't overshoot. If you have like 7 bars, or more than 7 or 8 or whatever, what happens is the market goes into an overbought or oversold condition, and it becomes ripe for sellers to start, you know, selling. So you don't want that climactic move. You want a rally that is a basic, moderate rally. These big rallies, trying to buy pullbacks on these big rallies, is not a good idea, because if they overextend, they're gonna, in my opinion, it's just my opinion, the sellers will start come in. But if it's a moderate rally, about 4, 5, 6 bars, you know, 4 to 6, like that, you're much better off. Alright, so that the number of bars matters a lot on the rally. Alright. Number of bars, consecutive bars, you have too many bars, and if it goes up too far too fast, you know, look at it. Is it too far too fast? Some may say that's strength, but it would only be strength if it's at the bottom of a trend. If it's near the middle or the top, I would not look. I don't want anything to do with it, right? Because it hits overbought, oversold levels or conditions on different indicators and all that, and sellers get attracted. You don't want it to go into any type of overbought, oversold condition, and you don't want like pressure to come in. Alright, so the number of bars matters. The second thing that matters is within the rally, you know, are you seeing high volume? It's really, really important. Are you seeing high volume in the middle of the rally, in the beginning of the rally? Like, does it have high volume in the rally? The bars that construct the rally, do they have high volume? You know, that's aggressive buying. Okay, you want that high volume here, here, not at the top, but you know, in the beginning to the middle of the rally, you want high aggressive volume, not at the top. Not at the last bar on the top, but in the middle and towards the low of the rally. You want strong volume, aggressive volume, meaning just high volume. So this is what matters. So within the trend context, we are looking at rallies and pullbacks. And the rallies, we want a decent number of bars, but not enough to enter an overbought condition. Alright, so we're looking for like 4, 5, 6 bars. Some cases 7, but like, moderate rallies. Okay? And aggressive buying within those rallies indicated by volume. This is the only way to detect it. I don't know any other way to detect that aggression other than volume. Alright, so that's the first thing. And the second thing about the rally: do not enter overbought or oversold condition, which is typically entered when the rally is very, very strong, and especially after it comes after multiple rallies. Alright, now from the low, a lot of times you'll have a very strong rally, and that's fine. That is an exception because it's just buying from the bottom, and or whatever it is. But generally, I like it like this because I don't want it for this to happen. I don't want sellers attracted, and on the bear side, I don't want the buyers attracted. So, and Wyckoff also had this. What he did was Wyckoff or SMI. What they do is they draw these lines, and they caution you when you have a strong rally that does this and hits, an overbought. The top of a trend channel is an overbought zone. The bottom is the oversold zone. Alright, so in a trending market, you want to see rallies. Okay, this is a rally. This is a rally. But when it shoots up like this, that's not that is a rally, but it can hit the top of the zone. You want moderate rallies. That's what I'm trying to get across. You don't want it to go into an overbought or position, because sellers will be attracted and they'll do something like this. And I'm not looking to get it here. Alright, so that's the first thing. Now, pullbacks. So we've covered the rally. Now the next thing is the pullback. What you're looking for in that pullback is you want it to hit a moving average, like an 18-period moving average. But more importantly, from a Wyckoff perspective, you want to hit the 50. You want it to tag or go below the 50% retracement. I think Wyckoff SMI wants 50% or something like that. In my opinion, even if it goes a little bit below, it's fine. I prefer it to, maybe even test the breakout, the jump over the creek with the breakout. So, and a lot of times for it to do that, it has to go below the 50% level. This, in my opinion, is critical. Why? Because buyers will step in. The market is offering opportunity at better prices than something like this, like here. You can have a lot of shakeouts and stuff. Like if you buy it over here, they might do this. Because if it's a big rally, you do this, they might do this, and then eventually do all this crap. So I want to buy a deep pullback, and what I'm looking for is a test of the 18MA, as well as a break of the 50% retracement level. This, in my opinion, is one of the keys to buying pullbacks. Really, 50%. I tried, not just using the 18MA, or not looking for a deep retracement of at least 50%, and what happens is they'll shake you out. Because what they'll do is they'll put 1 or 2 bars up, and then you're like, the rally's continuing, but it's not. They're going to shake you out, and it happens a lot. So you want a deep pullback of, or I say too much, but over 50%, or like tag at least 50% with the tag of the 15 MA. And this is pullback, or what's known as contraction. Okay. So when it comes down, you can have multiple structures. So now we're going to move to the structure of the pullback. You want like this, like this. I'm not too crazy about this, but I like the second the most, but whatever. This is a ABC correction. This is a 135 correction. Whatever, but the point is it better hit that 50% line and go attack below it. Alright, now I'm going to explain what's going on here, what to look for. Alright, what you want to look for are two things. Let's start off with two things. One is a lack of supply. And an increase in demand. So over here you want to see the supply dry up and then some type of increase in demand. That's basically it. Alright, now how this comes up, I mean, I'll show you numerous examples. But once that happens, that means that basically one side is drying up and the other side is coming in. And then you have a shot at, okay, now there are a lot of subtleties to this. A lot of subtleties, like when will this break, when will it fail? This will fail, for example, if this correction right here, if there is high volume here and it goes down, because instead of it being a pullback, this can become that other thing known as effort reward. Okay, and basically they'll be selling this. Usually you'll see something like this. You know, after multiple waves up, it looks like it's a pullback opportunity. High volume comes in here and it breaks the low of the bar. Okay, and you're thinking, what the hell? I thought this trend going to continue. But what happens is the seller stepped in here and they start selling. So when it comes back up here, it's actually going to drop because of the effort reward, because all that volume is actually selling. And this usually happens after multiple waves up. You'll see that. So that's when this type of bull flag, pennant, whatever you want to call it, rally reaction, it breaks. So you want to look for something's up. Okay, and by the way, there's also springs and upthrusts. So I'm going to give some examples of upthrusts today. That I took one. So the first thing here is context. Which is trend plus momentum. Trend plus Momo plus levels, TML, on both the lower time frame and the higher time frame. A lot of times you can counter trend on the against the higher time frame. If the lower time, it's not recommended, but I see those opportunities all the time. What you don't want to do is reach a level, like a breakout or breakdown level on the higher time frame, or testing or support or whatever. That's when things just don't work. So the first thing is you need context. Without context, it's all shit. Alright, the signal, half any strategy to buy or sell is context. Maybe more than half. Alright, half of any signal, whether it's springs and upthrust, F for reward, corrective, whatever, is context. You'll find out this the easy way or the hard way, but this sets up the environment for the trade. Okay, and there's more advanced topics within context. What is the bias of the day, news. There's a lot of other things also. There's also internal context, which is different, but this is all you really need to know. Trend, momentum, levels on both the lower and the higher time frame. The second is pullback. Rally. It's rally, pullback, and then continuation. So on the rally, you're looking for a number of bars, right? Making sure it doesn't enter overbought, oversold condition, and an aggressive rally, a rally that has high volume in the buying bars. And the pullback, you definitely want structure, right? But in the bar charts, it may be a little more, complex corrections that they have crazy structures. But anyway, you want 50%. You want contraction. That's what you want, and that will be in the form of a 50% retracement. And when it hits the 50% or dips below it, you know what? It's gonna definitely tag the moving average, or very likely tag it, because it's not overbought. Because we're not doing overbought rallies. So 50% would pull back good enough. And then you want continuation, evidence of a lack of supply and an increase in demand. Why? That means the sellers are tired and demand has stepped in, and that's when your edge is present for what? Continuation. Alright? So you have a rally, pullback, and then you have continuation. Where you have lack of supply and increase in volume, increase in demand. And the way you see that is through volume, as well as it can also come in the form of price ranges, the thrust, the range of the bar, a big range bar. Will typically continuation will have volume, big range, or just big range, or just big volume, or something. But volume and range, they will trigger. And of course the close will be high-end close for bullish rallies. So this is the basic idea. Alright, so now that I've given this information on how I interpret things, let's talk about gold. Alright, now gold, what did I do? 1 second. Alright, so gold, I'm just checking this chart. What you see is a rally. Alright, now it's going sideways, and over here it's in an uptrend still, but over here you get your rally. Alright, you make a low high, lower low, lower high, lower low. Now you see how I'm marking the lows automatically over here. Now I'm just, for me, I mean there's many different ways of having trend and momentum. If you're going to program something, you're going to have to use an indicator. So you can use highs and lows, or you can use moving averages with MACD. Nothing wrong with that. But you need trend and momentum. However you do it, up to you. So in this situation, what you have is a rally here that failed and went down. Now this is very important to notice, because this rally, and this is why volume is so important, this rally was failure. This rally is failure. This is a failed attempt. Now how the hell would you know if you didn't have the volume? Okay, how would you know demand failed here? How would you know? You wouldn't know. They look the same. This bar and this bar look the same, right? But this has double the volume. This has this volume, and it couldn't push price higher. What does that mean? That means that there's something called bag holding or effort reward, meaning you can keep on buying and I'll keep on selling. Alright, the buyers tried by buying and buying and buying, could not go up because someone was blocking it. Someone didn't want it to go up. How is it possible that you have double the volume than the prior rally, yet you can't even match the high of the prior rally? See that? This has 20, this has 44. But if this was buying pressure, wouldn't it be at least the same or more? Or double the distance? If it was buying pressure and they were buying, yeah. But the fact that it couldn't do that means there was bag holding. There was this selling. So you keep buying, I keep selling. Someone's selling. The buyer's buying, someone else is stopping them. That's how you read this volume. After that, the proof was here by the lower low. So now this area can be sold because there's a strong seller here. So it goes up on low volume, right? So that's the first opportunity to sell right there. Right? And then it comes back down, and this is what I like. It goes down 1, 2, 3 bars, then it comes up 1, 2, 3, goes down, goes up. Again, you have high volume, right? One brick high volume can't go higher, and instead there's an up thrust. Can you see it? So we have high volume, and you also have high volume that doesn't make any buying progress, right? Doesn't make any buying progress, and instead attempts to go higher but closes lower. What's that telling you? That means this is a resistance from a area that broke down. So this is an excellent shorting opportunity. And once it up thrust, more selling comes in. Once it up thrust, more selling comes in to go lower. Now notice, all of this is making sense because look at the trend. I'm using moving averages, you use whatever you want. Moving trend is down, and what is momentum doing? It's down. How is it down? Look at it. It's stacked and sloped, or whatever they call it. It's down. Alright, so over here you have more sellers come in after this up thrust. Right there. Up thrust is up, down, up. Tries to attempt to go higher, fails, breaks down. So that's your up thrust, and then it goes down. Now there's another up thrust, you'll see. So it comes back into that same range, same area, right? And this time there's a lack of supply, right? You see here, lack of supply. Lack of supply. Oh, excuse me. What the fuck am I saying? Lack of demand. Yeah, this low volume is a lack of demand. Comes down. Comes up on what? Heavy volume. And guess what? Reverses. Doing what? An up thrust. But understand the volume. It attempts to go higher. It can't go higher. So why? Because there's resistance here. There's sellers here. Look at this, 31. That's a lot of juice. yet it can't go any higher. Instead, it's reversed by 67. You know how much volume that is? 67 volume is more volume than the entire wave. The 2 plus 9, 11, 13, 23, 29. This came up on 67 volume. And what was it? An up thrust. So again, without the volume, how the hell are you going to read pressure? How are you reading supply and demand? So without all you would see is some bars that are red and green. What does that mean to you? Well, doesn't it make more sense if that bar had this kind of big volume, a big red bar with big red volume? Isn't that more meaningful? You know, if I just showed you this and bang, see that? Or if you have a buying attempt and it fails, isn't it meaningful? Buyers are there, evidence as supported by the volume, yet it immediately reverses. What does that mean? That means the buyers bought, sellers sold, and sellers are winning. So over here, this was the kick in the ass, and there was a break. Over here, I mean, what do you want me to say? It's the same thing. Trend is down, momentum is favorable, it's down, and these guys try to come up, and this guy came in and stuffed the move right here. These guys came in to that level, right here, the breakdown. What happened? Some big seller came in. Imagine your level of confidence if you just see a bar versus you see a big red bar with big high volume at resistance or breakdown. Where would you be more confident taking the trade? Hell, when would it even make more sense? Isn't this easy to understand as supply? Look, big volume, down bar, supply. So then, price continued down, and then did this, and once again came to the same area. Eventually I'm going to explain what SC and all this means and how you can detect a rally to these areas. So over here, why am I not getting any signals here? Is because I want contraction. Okay, if it's not hitting that 50%, I don't want anything to do with it. Hit the 50, but I guess maybe I want a little bit more. Oh yeah, momentum changed to the upside, so when momentum goes up like this, I'm not in the mood to sell. I don't know what's gonna happen. Like this is a pretty strong rally, and then they can do all types of, they can just go up. So this rally right here caused the momentum. You see this rally, 1, 2, 3. This caused the momentum to change and become bullish. Now obviously you have a 1, 2, 3, 4, 5 rally back down, but I don't want anything to do with markets that aren't clear. Okay. Now over here momentum is back down, context is down, but in this case price is not coming back to 50%. Here again, and this is probably because of extreme weakness or high momentum or heavy selling, but those are just not the markets I want to be part of. because they tend to do a lot of shakeouts. Like you'll have a move down, then go up a little, then go down, and then totally reverse. And I just don't want anything to do with that. Okay, so and now we're up here. So the key is rally, a good reaction, contraction, and whatever else I said. So that's one style of trading pullbacks. Okay, and you see how the volume is used to identify supply or demand or failed demand. Here, demand failed. Why? This volume is not bullish because it was immediately reversed, which means demand tried and failed. There was sellers here. So this is failed demand here, failed demand here, and we just call that effort reward. It means that there's a lot of pressure, but the price is not moving up. It's also known as a price volume diversion. If you might hear that something like volume is high and the price is not moving, or something like that. But that's the idea. Failed demand here, failed demand here, failed demand here, and that's all she wrote. So this is how you want to really, from a Wyckoff perspective, you always trade with a trend, right? Wyckoff perspective, you always trade with a trend. Second, but I modified that to include the momentum. I think in the Wyckoff method they call it speed, but it's the same thing: momentum, speed, whatever. So that's the first thing. Second is understanding basic structure of how markets move. It's rally and reaction, or rally pullback, or rally contraction. So however you define that for yourself, this is a rally, this is a contraction, pullback, or reaction, whatever you want to call it, then you focus on what you want to see in the rallies and what you want to see in the reactions or pullbacks. You want to see one wave pullback, or maybe a two wave ABC correction, or a three wave, or 1, 2, and 3, whatever you want. But the key is how much of a pullback you get while the market is continuing to trend and has momentum. While the market continues to trend and has momentum. Whatever pullback structure you have in mind, think about that. And then, where's the signal? The signal has to be within the pullback, and the only way to do it is with supply and demand, right? So, or you can have just price in terms of like up thrust here, or springs. You use that. I use the up thrust, and also concept of effort reward, how it comes in to play. Also critical piece. And that's about it, because it all comes down to rally, contraction, continuation. And what you're trying to do is get continuation so you can get the rest of the trend. Alright, I'm done.